Hey everyone, this is Professor SQ, and I thought that I would go over the Exam 1 study guide with you guys. I'm getting some emails about some questions, so I thought let's just go over this together, and I'll post this out on Blackboard. So the first one is know what your product and period costs are and examples of each. So in every class, I've always told you what are the three product costs. So make sure that you know what those are and how to identify those. And period cost, we talked about our period or costs that are incurred in the period that they are incurred. Product costs go to the inventory account, which is balance sheet first, and travels through the balance sheet and ultimately ends up in the income statement as cost of goods sold. Period costs are things like administrative cost and selling costs, and they go directly to the income statement. Next one, job cost sheets. What are they and when are they used? So here what I want you to do is remember when we had the lecture, especially all of the different source documents that go into the job sheet, cost sheet. But ask yourself, what is the purpose of that job cost sheet? What information is it capturing? So that's what I want there. And number 3, know what types of manufacturing costs. And manufacturing is the same thing as production. And if you hear production, you should hear the word product. Okay. Number 4, know the flow of the cost through the job cost order system and the related journal entries. Know the flow of cost, number 5, through the process cost system and the related journal entries. If you remember, the journal entries are pretty much identical, except in the process costing, you have the additional entry of moving from Department A to Department B. Also, don't forget in these journal entries, when we actually have the entry to record a sale, we do 2 entries. We do the sale, and generally if it's on credit, it's an accounts receivable. And then we have to recognize the cost of the item that we're selling. So it's an entry to cost of goods sold and a credit to finished goods. Number 6, what manufacturing costs are variable, which ones are fixed? If you think about that one, excuse me, we did a whole exercise on what costs are variable. Just remember, variable costs will be those, and we're talking total variable cost. So generally those costs that as the activity base or cost driver allocation base moves up and down, total variable costs will move up and down. But there are some costs like depreciation, rent, those type items that are fixed, and those don't change. So what we do is we do the predetermined overhead rate and gather all of those costs and then spread them out over the estimated activity base for the period. Okay, so hopefully that's clear. Number 7, understand the relationship of total variable cost per unit, total fixed cost per unit, the relationships to increases and decreases in the activity base. So here I'm asking you, how do costs behave? And I'm also asking you, what would they look like graphically? Okay. So if you remember, there was a chart that we did when we covered that section that talked about how total costs behave, how cost per units behave in both variable and fixed. Don't forget about mixed, aka semi-variable costs, because those are in there as well. Number 8, the composition and differences between traditional income statement and that says contribution, but it should be contribution income statement, forgive me. So a traditional income statement is sales minus cost of goods sold is gross profit minus operating expenses equals net income. Traditional income statement says we're going to take sales minus all variable costs will give us contribution margin. minus all fixed cost will give us NOI. The difference is contribution income statement is used internally for managers, and what we're doing is separating the costs, the ones we can easily control versus those that we cannot easily control. In a traditional, we're just looking at sales minus all of the costs that are related to selling the product, gives us gross margin and that gross profit, and that gross profit goes to covering operating expenses. Okay. Number 9, what are over and under applied overhead costs? How do you determine when they occur? If you remember when we did this in class, we created a manufacturing overhead T account. One side was for applied and the other side was actual. So go to the section in the textbook for the T account. Remember which side is the debit side, which side is the credit side. If a overhead cost is over applied, that means that our predetermined overhead rate was too high when we did our estimate, and that means that we actually charged our customers too much, and when we make that final adjusting entry, our net profit will increase. If it is under applied, that means our estimate was below what the actual costs were, and when we make that adjustment, we're actually going to have to increase cost of goods sold, and that will result in a decrease in profitability for the company. Number 10, when to use the job order cost listing, when to use the process costing. If you remember, we did the exercise in the workbook and we looked at each different scenario, and so we said, is it a job order costing? Is this a type of job that is unique? We would do a small run of or a single one, and then once it's done, we probably will not do that job again, or if we do, it'll be a different variation. Versus process costing, which is homogeneous products such as peanut butter, water, soda, and we just have a continuous run. We may do a little bit of a variation, smooth peanut butter versus nutty peanut butter, but generally the process stays the same. Number 11, know how to overhead costs are traced to units of production in job costing and in variable cost systems. So we trace it because when we do our work in process, we do manufacturing overhead applied. So first of all, you need to know how to calculate predetermined overhead rate, because that is the measure that we're going to multiply by the actual activity base, cost driver allocation base that is consumed for the job or in the process, and multiply it by the predetermined overhead rate. It's going to stay and carry through the inventory account into the balance sheet, into cost of goods manufactured, until we actually sell it. Once we sell it, it'll go into cost of goods sold. We'll do that comparison of manufacturing overhead applied to actual manufacturing overhead, and that's when we'll do the adjustment. The reason we do the predetermined overhead rate, number 13, how is it calculated and what is its purpose? Predetermined overhead rate is that estimate that we need, because in order to have a completed product, you need direct materials, direct labor, and manufacturing overhead applied. We use applied because we don't know what the actual manufacturing overhead costs are until the end of the period. However, at the beginning of the period, we need to be able to add that cost into our job or process cost, so that when the job is completed, and if it's completed prior to us having all of the actual data, we can complete the job and bill the job to our customer. Number 14, determine the number of units transferred out of the department. So this is beginning work in process. So what was on the assembly line at the beginning of the period, plus any costs that are, or number of units that were added during production. That gives us the total amount that's out there on the assembly line. At the end of the period, we go and we look on the assembly line and say, so how much is still left out on the assembly line? We subtract that, and that amount is the number of units transferred out of the department. So all we're doing here is trying to figure out how many number of actual units did we get finished and completed from the assembly line to finished goods. Equivalent units for conversion cost. This should also read just calculate equivalent units because it's for materials, it can be for labor, and it can be for manufacturing overhead. Remember, conversion costs are direct labor plus manufacturing overhead. Prime costs are direct materials plus direct labor. So all we're doing here is we're taking the total amount of units that were completed and transferred out of the department for the period, and then we're multiplying the number of units that are left in work in process on the assembly line and multiplying it by the percent complete. We add those two things together and we get equivalent units. Calculating ending work in process inventory balances. So if you remember that chart where we had all of the calculations, so here we're looking at what was in the warehouse at the beginning of the period. We're adding to it those units that were completed and transferred. That gives us total units available for sale. We subtract off the ending number of units that are left in the warehouse at the end of the period, and that tells us the ending work in process inventory. Calculate applied manufacturing overhead. We already told you how to do that. Predetermined overhead rate times the actual quantity of the activity base consumed in a job or in the process. Number 18, what is the relevant range? How does it react to total fixed costs? So basically, we talked to you about total fixed costs. So for a relevant range, it's just the endpoints of a certain quantity, where any quantity that is used, consumed, purchased, rented within that area, that fixed cost will remain the same. Once you go 1 unit above that, then you'll jump into typically a higher tier, and that fixed cost will be the same from the next 2 endpoints. Okay? Make sure you can give me an example of that as well. What are committed and discretionary fixed costs? Committed costs are those that we commit to and they're hard to change. Discretionary are a little bit easier. Make sure that you can tell me examples. What are opportunity costs? Opportunity costs are those costs that someone will incur choosing one option over the other. Some costs are those costs that occur once you purchase or invest in something, and once you've done that, you will never recoup those costs. Those costs are not relevant to a decision. How to be able to calculate costs using the cost formula. Y equals A plus BX is the cost formula. Y equals total manufacturing overhead or total cost. A equals total fixed cost or total fixed manufacturing overhead. A is cost per unit or variable cost per unit. And X is the activity-based cost driver manufacturing overhead. Ignore number 23. We did not show you how to do the high-low method, so you do not have to worry about 23 whatsoever. And then number 24, calculating cost using the weighted average method. That is doing the estimated, the equivalent units, and then multiplying them, finding the cost per unit for each component, and then multiplying it out. So there you have it. There is a quick recap of the study guide. If you got any more questions, let me know. Study hard.